So can everybody see my screen okay?
Yeah.
Fantastic. Yeah. Okay, folks. So I'm going to get cracking. As per usual, if you have any questions at all, please jump in at any stage. But until then, if you don't mind just muting your microphone, because on my side, I get a lot of feedback and then the recording quality does be poor. So just kind of unmute yourself then when you want to ask a question. Just jump in. So I'll tell you what, I'm going to start off with some of the metals actually, because myself and Jerry were just talking. We had a web meeting yesterday, and I suppose silver is the one we spoke about. And when myself and Jerry were doing a web meeting yesterday, silver was up actually at its peak, as you can see here. And we were discussing kind of what to do next. And everything is really based upon whether you're a trader or whether you're an investor. I'll keep saying that. And it's two different psychologies. It's two different ways of investing. And if you're a trader, for example, when you see this push to new highs as such, what I tend to look for from a trader's hat on is the fact that, okay, this is kind of a bit of a consolidation here. We've gone way above that. We're likely to retest down here at some stage. When is anybody's guess? So what myself and Jerry kind of came up with the trader's hat on yesterday was that we get out here, and if silver came back 5% or so to here, we might get interested again, but preferably 10% lower, which is down here. So I'll just show you kind of from peak to trough. Like that move there, for example, is actually nearly 14%. The chart doesn't do it justice. It doesn't look like that's 4 days of trading in silver. So you've got to understand that some of the key drivers of silver prices, one of the main ones is, of course, the kind of the for want of a better word, the levy that China put on the exports of silver. That's obviously reduced supply. You've got silver being used in kind of the whole renewable energy type market, and especially with data centers and everything else that's popping up everywhere. So kind of, and then of course you've got this kind of byproduct with kind of all the uncertainty that's out there in the market at the moment. Obviously gold is getting a bid at the minute, and silver gets a bid with that too. So I suppose you're getting a Goldilocks scenario with silver at this moment in time. So understanding the key drivers is important. But having said that, let's say for argument's sake, and I always say this with oil too, let's say there's trade negotiations again with China, and all of a sudden they lift that embargo, or whatever word you want to call it. Then you're going to have silver supply come back on the market, and then you could see actually silver prices drop heavily. So you've got to be careful and understand what the risks are when you're investing in commodities. And we decided to treat this as with a trader's hat on yesterday. And as you can see, within today, this actually dropped. If I just showed you there, at one stage, this was actually down 8% today. So last night's futures trading closed around 10 o'clock. And since then, it was actually down 8% at one stage. So it shows you how quickly sell-offs can happen in this. So Jerry, just an answer to you, you could have actually, you nearly got to our 10% lower where you were going to buy back in. And that's what we decided upon yesterday, was that if silver retraced 10% or more, we would consider buying back in. Because normally what happens here, folks, when anything makes a new high, like we've done here, there's normally consolidation. So look at this example back here, new high, consolidation, retested a new high, didn't break through, more consolidation, then a breakthrough. And that's the way it normally goes. It's not just a straight line up. So if you had your investor's hat on, for you to expect every day to look at your account and see it going up all the time is obviously unrealistic. So with silver, if you're going to use an investor's psychology, you just stay in it, and you don't sell out of this until you think, okay, this is just way overcooked now, you know. So for me, the way I would want to trade this, if I was trading it, would be wait for a pullback, 10% or more, maybe a retest of this low, and I think you could expect it to trade up to the high again. and then I would exit again. So I would actually trade this up to the high, and then I would wait. I would wait for a pullback again to retest this kind of support area. So these lines you're looking at here at the moment are called Fibonacci retracements. And this is based off the low to the high, okay? And it's a mathematical formula, to cut a long story short, and it tends to migrate back to these levels as such. And this first level here, it's just coincidental. It actually brings you to old resistance. So this was old resistance. It's now new support. So I think there's a good chance silver at some stage will retest this level here, okay? And at that point in time, with a trader's hat on, I will be considering going long, but exiting before we retested this high. So I want to kind of just bring you back in time here. I want to bring you back to, imagine, I'm actually going to just fast, if I can just bring the chart in here. I'm going to want you to imagine that we're in this moment here. We've retested this high, we've now pulled back, and we're considering going long. We would have taken out the position here, and then we would have waited for a retest of this low again. It didn't happen, so we wouldn't have entered a new position, and then we have our breakout here. The point I'm making here is you want to be certain that this isn't just the start of a new top, okay? And that's why I'm saying here, if you buy back into silver, get out of here at the top, just in case this is a top forming in silver. We don't know. We won't know. Hindsight's going to be a great thing on this. But if it breaks through, so what? And what I'm saying here is, let's imagine we got out here, we sold here, bought back in, got out here. Okay, so we've made a little bit of money here, right? Okay, we've missed this little run up here. But having said that, if this does come back to this support area, we buy back in. We've got confirmation and proof now that we've broken out. So that's all I'm trying to say with silver. I think you've got to really treat this with a trader's hat on. And I think you've got to be very cognizant of the news as well. You've got to follow what's happening geopolitically and in terms of trade news as well. I think it's very, very important for this. So that's just silver. Any questions on that? Please jump in. Looking at gold, made a new high the other day, so it's after breaking out. So that's a really positive sign, guys. So I would be less inclined to trade gold. So silver tends to move a lot more than gold does, okay? And if I'm an investor, I would treat this with my investor's hat on and just leave gold on. And the reason for that is we keep making these new highs. So that was a new high, bit of a pullback consolidation, new high, pullback. We've made a new high, and we're probably going to get a pullback at some stage. But trying to time this one, I think, is a mistake. My view is it's in a clear uptrend. I wouldn't fight that trend. I don't see any reason for hopping off gold at this stage. So I would leave it on. Is that okay? If you have any questions, please let me know. Okay, just jumping in here back to the S&P 500. So our go-to strategy again is really this short put strategy, and I'm going to talk about it again from two perspectives. One is from people based in the UK and Ireland. They can do it in a tax-free environment, and then people outside of that jurisdiction, probably using interactive brokers is a better way to go. And I just kind of want to just re-explain some of the things you need to really watch for and why we're being so patient at the moment. We haven't put a trade on yet this year, an options trade, and there's a reason for that. What we're looking at here is the S&P. It's kind of grinding higher as such. It's making new highs, so that's still a bullish trend. Can't argue with that, so it will bode well for our strategy. However, option premiums are based upon a lot of factors, and one of the biggest factors is volatility, right? And what you're looking at here is a chart of the VIX, which is a chart basically mapping out options implied volatility. And what you're seeing here is the VIX was at kind of a low here. As you can see, it's starting to climb a little bit again, but 16 is very, very low. And normally, you know what, the average is a kind of 20 and above. So what that means for you in terms of option premium is that you're not getting paid a lot to sell option premium at the moment. So if we go into the interactive brokers platform, just for argument's sake, we look at SPY, which is the exchange traded fund. that tracks the S&P 500. And normally in this platform here, guys, so I'm just talking about IBKR. When you're selling options, the best time period is 30 to 45 days out to expiration. And I explained that clearly in the course that I've done on the short put strategy. But just very quickly, the reason why is because we're looking for time decay. We're looking for the value of that option to start rapidly decreasing. Think about it. We're selling something here. We're not buying it. So we're selling a put option. So let's say we go down to the 660 strike here. We're going to take in per contract here at the moment. We're going to take in just over $500, right? And you can see here, when I put that trade on, I'm just going to show you that probability of profit is 89%. Why is that? Just want to explain it to you again. I'm going to go back to the chart. If you look at SPY here at the moment, it's at 690. We're selling the 660 put. We're taking in $5 in income. So our break even is down here at about 655. So I'll just put a line down there at our break even. Okay. It's about here. Okay. So the point I'm making here is the reason why it's such a high probability, we're going to make money if SPY goes up. Sorry, apologies for that. If SPY goes up, if SPY goes sideways, and if SPY goes down. As long as it doesn't go below our break even of 655. That's why our probability of profit is so high. Now, I want to do a big distinction between an index like the S&P 500 and an individual stock. What's happening now? We're coming into earnings season, right? Implied volatility, and it's really important you understand this, kicks up big time around earnings season. Why? Well, a company is going to tell you, is just about to tell you how well they've done. They may have done really well, and they may be forecasting further growth going forward, or they may have missed expectations, and then they might start guiding lower. So what happens in the option premiums, the market makers start pricing in that uncertainty. We don't know which way this is going to go. Therefore, you're getting more option premium for individual equities. My advice to you guys is, unless you want to own a stock, don't do this strategy with individual equities. Only use this strategy with equities when you want to buy the stock itself. Okay, that's it. But you can use it with an index like the S&P 500 as a return-based strategy. What do I mean by that? What I'm saying here is that month on month, you could be doing this strategy generating a premium. So at the moment, the premium, it's just under 1% for just over a month on a trade. And we know that the premiums are really bad at the moment because implied volatility is low. And when implied volatility does pick up, those premiums will get better. So that's why I said in my message yesterday, it's nice to see the S&P 500 sell off. Why? Option premiums go up. And when we go to sell the option premium, we're getting paid more. So for example, yesterday, at one stage, we would have got maybe $7 for this instead of $5, because the market was down 1.2% at one stage, and it only closed down 0.5%. At one stage, that premium was up closer to 7. And that's because the implied volatility had shot up. So I just wanted to explain all of that to you. And my real message here is, please stick to the S&P 500 or indexes for this strategy. And the main reason why is you can actually back test and see what the average move is in something like the S&P 500. And then worst case scenario, if the trade goes wrong and you don't manage it, which we would do, but if you didn't manage it, I could think of worse things than getting assigned the S&P 500. Whereas if you get assigned an individual stock, if that's turns in to be a dog, you're in trouble, because it's going to be very, very hard to manage. So I hope that's okay. Just wanted to just explain a little bit of differential between trading the index and trading individual equities. So the trade at the minute, I'd be lining up if I was going the IBKR route, okay? So this is just for interactive brokers. I'd be looking out at probably February the 20th or the 27th. I would still stick with the 650 short put at the moment. The premiums aren't as good, but I wouldn't be ready to place this yet. I would probably give this till next week, and let's see, do we get a bit of a sell-off in the market and we can get more premiums for this, okay? So the next thing is, well, how would we manage that trade? Well, let's say we put this one on. We're going to take in, at the moment, just under $4. The question is now, well, what if it goes wrong and the S&P starts to fall? My trigger to get out of this would be 656. So if the price of SPY fell from 693 at the moment to 656, then I would take action on this. What action would I take? I would buy myself out of the 650 short put. So I buy the contract back. But then I want to kind of get my money back as such. So I would open up a new contract and I would go out to the end of March. And I'll come into March here and I'll say, well, where in March, what strike price in March will I get roughly $4 in to cover the cost of buying myself out of the end of February? And you can see here it's at about the 625 strike. So the point I'm making here is we've already established with this strategy here, we could sell our 650 put. If things start to go pear-shaped in this trade, in other words, the SPY starts to do this, our trigger point here is 656. At 656, then what I'm saying is we're going to roll out and down. What that means is we're bringing our break even all the way down here now. So instead of being concerned here about SPY continuing to fall, we've now given ourselves a lot more wiggle room. And that's why this strategy that I apply, guys, has a 93% success rate. It's because when you manage it correctly, it's very, very unusual to have to get assigned or to actually lose on the trade. But you have to manage it, and that's where we come in and we'll let you know when we're managing the trade. So I wanted to tee up that one. If you have any questions on that, please jump in. Because I'm going to flip over to IG Index now and just cover the exact same strategy. The only difference with this one, guys, I am still looking at the January 30th one here for people based in the UK and Ireland. And the reason for that is, for the challenge, I want to do one a month, okay? I'm just waiting for my opportune time. And at the minute, these premiums here are terrible. So the put option setup is slightly different with this. This is like a bet, and this is why it's tax-free. What IG Index have done, they've wrapped up option trades as a bet, so it's tax-free, okay? So ultimately what we're doing here is the premium on offer is 6. If we put a bet size in here, for example, at 20, what we're saying here is we're betting 20 times 6. We could make $120 if the S&P 500 stayed above 6,500 by the end of January, okay? That's what that means. And if we start to lose, so let's say for argument's sake, we didn't manage this and the S&P 500 fell to 6,400, we would lose 20 times the difference between the strike prices minus this premium we took in. So we'd be losing there roughly $1,800 for a trade of that bet size, okay? Now, what we would do is something similar. We would roll out and down, okay? So that's what we'll do in reality. So I'm still waiting on this one, folks. And what I just want to mention to you is, okay, the futures are up today. Some of the banker, I think Goldman Sachs just released their earnings and a couple of others, and they were quite good. So it's given a bit of a push to the market. But that could all switch by the end of the day. We'll see. I'm still waiting to see, do we get a bit of a sell-off in the S&P? And if we do, then I'll put on that January 30th trade. If we don't, I'm just going to be patient and wait. And then I'm going to go out to the end of February. And I'll apply a trade there. So I'll keep you posted on all of that. Is that okay? Have you any questions on that? And again, just want to remind you, go to the knowledge base. I've done a quick, this first course here, it's literally just a quick guide to the IG Index platform. How do you actually go and sell a short put here? So I would really encourage you to go onto your demo account, go through this step by step and place lots of trades. Just get used to it. It's more straightforward than interactive brokers, actually. There's less into it, but I think it's worth your while going through that, okay? All right.
Stephen, it's Roy here. Just a question on the IG Index trade, okay? When you roll out and down, that's fair enough. What happens to your margin? Because it's roughly at 60% on that trade you're going to do it there.
It's a great question. So I'll tell you what I'll do. I'll go and I won't place it because this is the account I'm going to use for. But what happens is the margin was roughly $6 grand. So when you buy it back, Roy, obviously the margin disappears, and then you open up the new one, and your margin will be roughly the same, I would imagine, in and around 6 grand on that.
Okay. It doesn't give you a margin over 100%. Like you don't get
No.
it goes up to that, and that's it.
Correct. Their kind of margin here, right? It's not the same as what you see in interactive brokers where you're getting charged an interest rate and all that. It's like, look, you're not allowed to trade with anymore. So if you have 10 grand and your margin is 6, all that's left available to you to trade with is 4. My rule of thumb for everybody with an IG index account, don't let this margin get over 60%. So what I'm saying is, let's say we put this trade on and it's at 60% and then it creeps up to 70. I'm not too worried about that, but don't start putting on a lot of trades and bring your margin up to 95%. In other words, 9.5 grand, because what happens with your margin, if the positions start moving against you, your margin requirement goes up. And therefore they might start selling the position on you. So you want to give yourself some wiggle room for the trade to go wrong for a little while. And by the way, just to mention that, Roy, on this trade, for example, here, you can see the 6,500. See the difference here between the sell price and the buy price is $1.50. Yeah. So let's say we put a trade on this, we would be down $30 in this trade straight away. It's just the way the pricing works with IG index. You've got to expect that when you're doing it, so people don't get a shock and go, oh, why am I down straight away? That's the reason why. It's just the difference between the sell and the buy price. But the dynamic is still the same. As long as US 500 stays above 6,500 at expiry, you will make, let's say, 20 times your 22.93 here. Okay?
Okay. Thanks, Stephen.
No problem, Roy. Any other questions there, folks? No? Okay. We've covered. I just had a quick look at oil, folks. Obviously, oil kicked up, guys, because of what was going on in Iran. And look what happened here. So a big sell-off now again. I think this is going to go back down to 55. So I wouldn't be getting excited here that this sell-off means anything in crude oil. So anyone who has USO or anything like that, you might want to take it off the table. That would be my best guess. Because like I look at the risks to oil prices, and like if unfortunately, it doesn't look likely, but if there is a ceasefire between the Ukraine and Russia, for example, you have to factor in that the market start pricing in Russian oil coming back onto the market. And I think that's going to be a problem for oil prices. Yes, OPEC will come in then and start cutting production, but the initial move will be down. So I still think oil is too dangerous here to get involved in my opinion. So I would just be patient and wait there. And same for oil stocks. You know, if you're in Schlumberger and Halliburton, who've had a good jump lately because of Venezuela, I'd be probably taking the profit off the table on those two. Okay, the 3 stocks that I focused in on, I put messages out: Dell, Arista Networks, and AMD. Pretty much all benefiting from the same move in AI as such. I've sent out little notes and in equity scan. So if you come into your equity scan here, for example, and type in AMD, and I'd encourage you to keep logging into your equity scan. And by the way, if there's a stock in here that you're looking at and you can't find it in here in the database, let us know and we'll have it in within 24 hours. Okay. So you can see just our target price is a small bit lower than the analyst target price. We've used forward multiples of 25, which is realistic for something like AMD, to be honest. But I kind of outlined the risks here. The great news is, a little bit like Dell, the backlog of orders is off the scale. But the downside is, of course, is this margin pressure that's coming in here. And that could be a problem for AMD. So the valuation multiples as well are quite high. They're on the higher end as well. So if we do get into any margin pressures, these multiples could come down. Okay, so I want to highlight the risks as well. But like Dell, the demand is off the scale for their product and their service. And for that reason, I still think you have to go where it's hot, in my opinion. So I'm waiting on AMD. I'll just go into the chart here. It's in a nice little consolidation phase here. You can see it's pretty much going sideways here. So I think you could actually do this on both a long-term trade and a short-term trade basis. So what I'm really waiting to see is, does this high get taken out? I'm going to just make that higher. So if that high gets taken out there, well, then that would kind of convince me we're going to attack the higher end. And it might be counterintuitive, but I'd be more likely to buy in, to be quite honest. My best guess is that we might have a little retest down here. And I want to see that this could be classified as a triple bottom then. And if it does hold, you know, I could be buying in here as well. So I'm waiting for two scenarios. One is a breakout and one is a breakdown as such. So if I'm short-term trading this, I'm certainly waiting for this to see there's a pullback again. I wouldn't be jumping in now. Long-term investing, you can always apply a dollar cost averaging strategy, buy a bit now and buy some later on. So if it does fall, then you're averaging in at a cheaper price. And then if it does break out, okay, you're averaging in at a more expensive price, but you know, the chances are you're going to see this high at least be retested. You know, and ultimately that's where our target price, it's pretty much up near there. So we just did a little idea here. It's been there before. That's 17% higher just to get to those two levels here. So that's one of the reasons I like it. I do think it will get a retest, but we need to break out of this little consolidation phase here first. And that's what I'm waiting for, okay? Arista Networks, you can see it's pretty identical, really. If you look at here, you can see consolidation phase here again. We're coming off the bottom of that consolidation phase, and we're still below that 50-day moving average, which is trending downwards. So I think, again, at some stage, we make a kind of a stab here to 160 level at some stage. One thing that I would be a little bit wary of with this one, just kind of, is this a double top? And we won't know till after the fact, you know. So it really struggled here to really break out again, and then it just continued to sell off. So again, I'm just going to monitor this for a little bit longer, but these are the trades I'm lining up both on a short-term and a longer-term basis. Again, if you're in the camp, and there's a lot of people that are, by the way, if you're in the camp that the AI trade is overdone, well, then you stay away from these three stocks. You don't go near them. Personally, myself, I don't think that's the case. That's my own opinion on it. But again, still not ready to pull the trigger on any of them, but I just wanted to start teeing them up for you and explaining what I'm talking about, okay? So that's what I wanted to bring to you guys today. Is there anybody out there with any questions?
Yeah, I bought AMD last week. It's up 20%. Should I get rid of it and buy it back, you think?
I don't know. So if you're investing, Stephen, I would hold it. So I wouldn't be selling it here if you're in it with your investor hat on. If you're a trader, however, if you're just kind of trading this thing, you're up near the kind of the higher end of the recent consolidation range. So with a trader's hat on, I will be saying exit now, because it's up 2.46% in pre-market, right? So it's up. It's going to open up right here at this previous high, okay? So what you could do is exit. Now, this is trader's hat on. So I want to distinguish between the two. So you would exit here, take your profit off the table. This is where it is now in pre-market. And then if it kind of blows through here, you know that there's probably going to be a retest. You could go back in and there's a retest, because this will then become support. With an investor's hat on, I would just leave it. I wouldn't be selling out at all. Okay. Does that answer your question, Stephen?
Yeah. What do you think of the concept of selling the leap that I have and then holding on to the call I sold against it?
No, I would never do that, because just from experience, Stephen, that's where you can get yourself into big trouble when you've sold calls on something. So, for example, there's earnings coming up in AMD in 2 weeks' time, just under 2 weeks' time. Anything could happen. I know. I think your expiry is before then, so it's not too bad, right? But let's say there's news out tomorrow. For example, like it did jump 6% yesterday. What happens if this jumps 6% again? What strike is it at, by the way, that call that you sold?
I got 225.
Yeah, so like 6% from here, like will bring you up right up to 240 or something like that. So you're going to be down substantially. Let's say if it did jump another 6%, for example. So for me, and it's just my opinion, if you're going to close the leap, close the short call as well, and the short call will be showing a bit of a loss, I would imagine. That's
Yes.
okay. You're making it up in the leap, in the gains in your long call option.
Sounds good. I think I'll do that.
Yeah, I would sell both of them together. Yeah, absolutely.
Thanks.
No problem, Stephen. Any other questions, folks? Okay, just to let you know, we're developing the app. The app is going ahead and will be ready in about 4 to 6 weeks, we're told. Again, if you have any input as to what you would like to see in it, please let us know. Another piece of news for you, we're also building another piece of technology similar to Equity Scan, but it's going to be focused in on the US 500 short put challenge. So for people who don't trade the IG index, that's what it's based off, this tool, right? It's okay. You can use the same rationale for applying it to interactive brokers. In other words, you can use the same strikes, expiries. It's pretty much the same trade as such, okay? So that tool is being built. We anticipate that will be ready in about 2 months' time. And it just means that you'll be able to log in like Equity Scan here and actually see all of our open trades, how they're performing in real time, and then kind of an automatic log with backlinks into our explanation. So for example, when we do a trade, if I go back here, this is what we used to do, just to explain. So if I go back to our IBKR, we've organized it a lot better. We used to just provide a spreadsheet with our trades and then do a whole article here on each trade and what we did, and there was videos, etc. And we just found that too cumbersome for you to look at. So what's actually going to happen now, that new tool will have something like this, for example. It'll have something like this here. I'll show you actually a better version of that. I can't show you. There's a better version of this, and there'll be backlinks into, so this will automatically be updated for you, and then there'll be backlinks into an article tracking the trade every day, and every day I will post on that article saying, you know, hold, sell, or buy, or close out. So every time I decide to take an action on it, you'll know about it. You'll get an alert from WhatsApp. So all of that is coming. So I just wanted to make you aware of that as well. So we're constantly trying to improve your experience and make it easier for you. So the app will be great for even booking a mentoring session. There's going to be a button there for you to just book from the app, and you can schedule your mentoring session with me. You'll be able to track the Equity Scan, and you'll be able to do all of your courses from the app. So it'll make it a lot easier if you're using mobile quite a lot. Okay. Okay, folks, any other questions before I leave it? No? Okay.
No.
Okay, guys, have a good day. If you have any questions at all, you know where I am. Just WhatsApp me and I'll be happy to answer your question at any stage. Okay, thanks and bye for now, guys.
Thanks.
Thanks, Steve.
Bye now.
Bye.